Well, hello, everyone, and welcome to the latest edition of Conversations with a Pro Trader. I'm your host, Greta Wall, and I'm joined today by T3 professional trader, Scott Redler. He's also the leader of the Alpha Team virtual trading floor over for T3 Live. I know some of you may be part of his open house this week in the Alpha Team VTF, so thanks so much for joining us today for this bonus Q&A session alongside your trial. How's it going today, Scott?
Today was an interesting day. There was a lot of volatility again within this narrow range. It was kind of crazy.
Yeah.
The market opened strong, and then it looked like the regional banks and the banks and energy, which has been weak, were getting sold off, and then we're going to sell the market off, and then tech kind of held in there, and then things stabilized, and all of a sudden another sell wave, and then just as it looked like we were going to break, market rallied right back to get in the middle of the range, and a lot of back and forth with some good money out there if you're prepared and if you didn't like flinch and get frustrated. And it was definitely a tricky day, but I think for me, I had a really good day, and I hope those who are new to testing out the Alpha Team had a good day, and I hope that people just all together had a good day, because we were on top of what was moving, and we're trying to stay away from what's a little bit too volatile to know what's happening next.
Great. So just a precursor for everyone who has been here before, you know this, and if you're new to this format here on LinkedIn, this is a Q&A session between me and Scott. So we'll be having a conversation here about the market, the current action, what he's looking at, et cetera, et cetera. But it's also a Q&A session between you and Scott. So the live chat is open for you to submit questions there, and then the second half of this event, I'll go through and I'll ask him every single question that is submitted by users here. I'm going to leave a comment real quick here in the live chat, just so you guys see where it is, and you can ask him your questions throughout this. If you hear us talking about something you want more info about, or if it's something totally unrelated to what we're talking about, that is okay as well today. So submit any questions you have for Scott, and I'll get to them later on. Okay, Scott, my kind of opening question for every trader who comes on Conversations with a Pro Trader with me is to give me a grade of your week of trading so far. So it sounded like you would give at least today an A+, but what about the overall week? We're
Listen,
halfway
A
through.
plus is hard. A plus.
Okay.
I'd give myself an A-
For the
today,
week or
because you
just for
can always
today?
do better. I would say for the last since Friday, I would say a B plus,
Okay,
which a
great.
B plus could equal a lot of money. I'm always telling everyone net money, net money, net money. For the last 4 days, I've stuck with some swing trades. I used my tier system. We've been in the right names and stuck with them, gave things the right amount of room, didn't look at our P&L. We looked at what trade was the right trade and stuck with it. And even today, when it was a little, got a little crazy, we stuck to our guns. So I would say, yeah, A minus. I'm gonna give myself an A minus for
Okay,
the
great. That's great. Okay, so of course, the big news of the day on Wall Street today was inflation. We had the April CPI coming in cooler than expected on an annual basis. Just for everyone, I'm guessing everyone saw the numbers, but if you didn't, up 0.4% monthly, 4.9% year over year, better than that 5% annual gain that was expected by economists. You kind of talked about this a little bit. We saw a quick reaction, after the release at 8:30 a.m. Futures popping right after the report was released. Major indices, though, closing mixed today. We had kind of an up and down session for the S&P, the Dow falling later in the day. So talk me through your strategy for a pre-market release like this. How do you approach this pre-market, and then once the market opens?
Well, I usually don't like to take too much risk when you have a binary event like the CPI. I kind of felt like this CPI was a little watered down, wasn't as much as a focus. The last few CPIs, when we were really worried, where would the rate ceiling be? How many times will the Fed raise rates, et cetera, et cetera? It was really a focus, especially when inflation was on the way up and didn't peak.
Yeah.
Like right now, inflation peaked, and most people know that. The question is, how sticky will it be, and kind of trade in the right direction to the downside. So even if we were a little hot today, I don't think they would have been like, oh, the market's going to raise rates in June. Like people kind of think the rates are staying here, not raising anymore. The question is, what most people out there are saying is it's only a matter of time for earnings to fall off a cliff, for the market to break its ascending channels, and that the regional banks and all the weak sectors are going to weigh on the tech sector. And so far that hasn't happened yet.
Right.
So I kind of came in with a little risk on. And when I saw the CPI, I bought a few more things thinking, hey, at least it's heading in the right direction. We're not falling as fast as far as the disinflation bull theory wants, but at
Mm-hmm.
least it's heading there, and it's going to take time to normalize. But then, the market opened up and we used our pivots and our prices like we always do. Some things didn't hold, then some things faded harder than others, and then you had to figure out how to define your risk like every other day once that was behind us.
Yeah. So for maybe a trader who's not as experienced as you, or who is learning, the tactics that you use in the market every day, on a day like today, when you see a big futures pop and then an open and then a pretty quick reversal, at least for the Dow, the S&P falling flat, tech stocks doing pretty good today, but we saw kind of a pullback from that rally that we got right after the release. How do you protect yourself in that environment? How do you manage risk as that turnaround happens?
Well, first, what I do is I prepare myself with all the charts of the major indices and the leading stocks.
Mm-hmm.
So for me, the SPYs, 413.72 is a level that we haven't been above in a while. So my
Mm-hmm.
thought was, if, with the benign CPI, we opened above it, can we hold it and build, or do we not hold it and fade? So I did
Mm-hmm.
have some stocks overnight. So what I always do when a gap is in my favor, no matter what, I trim some to
Mm-hmm.
book money and net money, and then I figure out what will the composure be like for the first 5, 15, 30 minutes, for the next hour, and then for the day, because the day always develops.
Yeah.
So I did sell some strength, and then when we didn't hold the 413.72, and came in, I'm like, all right, not the biggest deal, but then all of a sudden, when we started to break below yesterday's low, I was like, ooh, this could turn into like an outside day. Not only did we open up and fail, now we're below a prior low. Let's see if sellers have power to keep us below it. And then
Mm-hmm.
literally we went back above it, which was 410.70 to close at 413. And it just proved to be another range day. So trading the range, we're very used to it. But if you knew
Mm-hmm.
where the high was that we didn't hold and the low was that we didn't stay below, it led you trade the ranges and create some cash flow and then stick with what you have commitment to based on your base case.
Right. Okay. So this inflation data today is, of course, good news for traders who are betting the Fed is done hiking rates. You said, yourself, they're done hiking, but the question is, when does a cut come, et cetera, et cetera. Fed Chair Jerome Powell, though, says they're not totally stuck on a pause yet. He said last week they hadn't made a decision. They're going to remain data dependent. So this data today supports a pause. Yes?
Yeah, I would say this data today supports, no rate hike in June.
Mm-hmm.
I'm
Right.
kind of in the camp that I feel like the street kind of has it a little bit wrong, and that
Mm-hmm.
the only way they're going to cut rates is all of a sudden if the economic news really starts to falter, if all of a sudden in 6 weeks from now companies start to pre-announce, and then you see things start to break, and you see the S&P that's been in this range start to correct, and all of a sudden volatility rises, then
Mm-hmm.
hey, the Fed will be, oh, maybe we went too far. But if we're sitting around 4160 or 4200 in the S&P, or if we rally in the summer to 4300, not saying we will, but we can, there's
Mm-hmm.
no way they're going to cut
Right.
rates. They actually
That
still want things to kind of squeeze out the excess.
That's something interesting that one of your fellow T3 traders, Patrick Hawes, mentioned on this with me in the past. Is the Fed futures are showing up to 3 rate cuts by December, but the market isn't trading like a market that's expecting something bad enough to happen that you have 3 rate cuts happening by December. It's kind of do you feel like there's kind of a disconnect between the Fed futures market and the stock market?
Yeah, and that's why everyone's on their toes. The
Mm-hmm.
bulls don't want to get caught if all of a sudden a down day turns into a big down day, which turns into a
Mm-hmm.
new active sequence to the downside. And the bears have been trying to short this market since the start of the year, because every economist said we'd be in a recession by January or February, and here we are, May 10th, and there's no recession yet. They've been
Mm-hmm.
getting their butt squeezed, and that's not a lot of fun. So they don't want to get caught short, and bulls don't want to feel like, oh, we're going to get caught long. So it's been a very fickle market where
Mm-hmm.
it's like love them and leave them, or take your trade, be on your toes. And until that changes, and I don't know when it does or how it does it, but when it does, it's going to probably do it in a big way, and you need to be prepared. When ranges resolve, usually they resolve and they have a directional move. And what ranges are meant to do is tire as many people out as possible so they don't catch the direction of the next major sequence.
Yeah. All right. So for everyone, again, just a reminder, if you're here with us live, submit your questions in the chat to Scott. I'm seeing those start to roll in, and I will get to every single one of them. So anything from beginner to experienced trader, if you want something specific, ask it and Scott will answer it. All right, Scott, so you kind of you mentioned this briefly. There's still a lot of underlying concern though about the regional banking sector in the shadow of all of these Fed rate hikes. Obviously, we've had a lot of turmoil happen in that sector. Fed Chair Jerome Powell on Wednesday said everything's all good, and then 2 hours later, PacWest all the PacWest news came out. And do you think the market's concerns about the regional banking sector are more warranted than what the Fed is maybe saying for the market?
Well, the Fed is kind of there to breed confidence. They don't want to help a bank run and fuel a situation that they can't handle. So they have to kind of talk positively. But the bottom line is there's been 3 banks, regional banks that went, Silicon Valley Bank went from 300 to 0 in 3 days.
Yeah.
FRC went to 0. A lot of these things are not really bouncing. So if there are 4,500 regional banks or so, and only 3, and that's supposed to be the strongest ones, went to 0, there's probably more than 3. Then the question is, like in 2007 and 8, when you had subprime loans, right? That was Countrywide and all those guys. And then you had JP Morgan, those guys have to forced mergers and forced marriages. And what that did is that watered down prime with subprime to turn into a lot of mediocre banks. And that turned it into very tricky sectors to be long. This could be similar, not the exact same. There's not as much intermingling of mortgages where people own 5 different homes with no docs, interest only, and one thing breaks up another. So the banking system has been much more sound, but it still could cause a little bit of a hiccup in the system where you don't want to be in regional banks, and regional banks are probably way on the wirehouses. So I'm watching the banks, and I'm taking tiny trades only the perfect time. And we actually did well. We've had 3 different sets of puts and caught 3 of them that went to 0 almost. So we're staying away. And I use an 21-day moving average rule, and the KRE, which is the sector for the regional banks, have been broken since almost February, well before the news started to hit. So if you use your technicals, they can kind of tell you a storm is brewing before real weakness and volatility sets in.
Yeah. It's interesting you mention the mortgage situation from 2008, and how you had the bad mortgages and you had the okay mortgages, but the banks with the okay mortgages had to kind of suck up the bad mortgages and kind of deal with some of that poison. When you talk about First Republic, JP Morgan Chase is the buyer of First Republic, and yes, they got arguably a sweet deal on all of the
17
assets.
cents for the common stock.
Yeah, but even on assets that they take over, a sweet deal. But they definitely are inheriting some issues from that bank. How does JP Morgan protect itself in that situation? Do you see a risk, or are they just so big it doesn't matter?
You know what? I'm not that smart. I'm just going to watch the action. JP Morgan. I look at the chart. The market cares when it makes lower lows on a week or a monthly basis. Right now, it had to move lower. It's in the middle of the range. If it starts really rolling down like today, let's see, JP Morgan actually went green. It helped. When JP Morgan was down $1 today and KRE was on the lows, there was a sell program in the SPYs, and that kind of dragged down the tech sector, but tech was strong enough. So knowing how the computers are programmed right now, whereas when more volatility spikes in the regionals and then waters into or filters into the XLF and then JP Morgan, then everyone starts to get too worried, and then you have to figure out what's stronger than what. And today was the case in point when they all started getting weaker, but then things didn't fall apart, and JP Morgan bounced. It's a bank that bounced. It wound up, the market bounced. So what I watch every day, I don't watch like Morgan and Goldman and Citigroup and Wells Fargo. I watch JP Morgan and the KRE. Those are the 2 things that show me that if they happen to be very pressured, it matters to the computers. But if they're like kind of in the middle of the range, then stocks could trade on their own merits, where it's not caught in computer programs that are just selling the S&P futures or the S&P cash.
Great, great. Okay, so you've mentioned this multiple times already today. Every trader I talk to discusses how this market is range bound. And today you mentioned it again, another range day for the market. We've been in this tight range for all of 2023 so far, or
It's 2 years. The S&P has been at
yeah.
this level and touched it for 2 years.
Right.
Two
And
years.
for traders who came into this market, maybe say example 2020, 2021, there was no such thing as range bound market back then. It was just higher, 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 no range. How do you find opportunities in this type of tight range bound market?
Well, then you look for very stock specific plays that
Okay.
have news, that have volume,
Mm-hmm.
that have great chart patterns, which is what our
Mm-hmm.
job is to do for everyone at T3 is find you actionable situations. That's why I write a note every day. I'm up at 4:30. I'm doing
Mm-hmm.
charts. I'm getting my note written. So by 8:30, it can be in everyone's mailbox that has 40 different names and how I'm approaching them and how we can create micro cash flow and then maybe have swing trades to make bigger amounts of money based on the individual name, but not expected from the indices. And we've done a pretty good job. Like the
Mm-hmm.
last 2 days, I made a lot of money in Google and Amazon.
Mm-hmm.
Google and Amazon, a month ago, were horrendous.
Right.
And maybe in the next few days from now, Apple breaks above the post earnings high. And for a year, Shop was horrendous, and then it reported numbers and had a pro earnings gap, and then started a new active sequence. So there are things to learn and tactics to use to create active cash flow on individual specific situations while we're in a range. It's
Mm-hmm.
not like everything's a sell or everything's a buy. So in the range, as long as there's not a lot of pressure on that moment, things
Mm-hmm.
usually, some things could trade on their own narrative. And that's
Right.
what I look for. And that's why, again, I prepare as hard or as early as I can to make sure I can find a few things that stand out to make money, which are not the easiest to find, but this last 4 or 5 days has been a little bit easier.
Yeah. All right. So before I get to the audience questions, we have quite a few racked up. So everyone get those questions in so I can start asking them and I don't miss you because we got a kind of hard out at 5:15 today. So make sure you get your questions in. I
Yes.
want to get your take, Scott, on another economic possible crisis that's kind of looming over the market, and that's the debt ceiling. Treasury Secretary Janet Yellen says the government will run out of money as early as June 1 and that they're already relying on, quote, extraordinary measures to pay the bills. Negotiations to raise the debt limit are at a standstill. The House Speaker is basically demanding spending cuts in exchange for a debt limit hike. He has passed his own bill in the lower chamber, the only bill that's been passed so far for a debt limit that it does include those cuts, but Democrats say it's a non-starter for them and it's an unrelated issue. So do you think we're facing a real threat of a default at this point, or is someone going to cave and it's all just,
You know
you
what
know,
this is?
yeah.
A lot of noise. I've been hearing about the debt ceiling since 2012.
Yep.
Actually, maybe when I was getting bar mitzvah, they were going to halt the bar mitzvah and say, hey, there's a debt ceiling negotiation going on because they went above it 20 years ago. So they've been increasing the debt limit every year. And every now and then, if it goes into default, it goes into default for a week or two. And yes, there's volatility and there's noise around it. And if you're very short term, you have to be careful because you don't want to have too much size when that volatility hits. But do I think that we're going to be in catastrophe, like what Janet said? If all of a sudden we
Yeah.
can't, we'll always pay our bills. I just think it's a lot of noise, and it's just something that we have to think about every few weeks. Is a different narrative that the market needs to focus on, and the media needs something to talk about because you have to fill airtime. But I
Mm-hmm.
think all in all, we have a very dysfunctional Washington, which is unfortunate. And I still can't believe I'm not going to talk politics. I'm a moderate in the middle. I don't like the far left and the far right. How can we have
Mm-hmm.
two candidates that are both going to be 80 years old running for president? What is the
Mm.
matter with all of us that we're getting the representatives that I guess we deserve because we can't find anyone else that happens to be better qualified? That's not a name So I'm very sour on the whole political landscape, and I've been told I'm not allowed to talk about it. So I'm going to keep it quiet.
All right, there we go. We won't talk about it. Real quick, one more question on earnings season. It's winding down. Next week, though, is kind of a big week for the retail sector. Home Depot, Target, Walmart are all scheduled to report next week, and then we'll get Lowe's early the week after. How important are these results to help gauge the health of the US consumer? Maybe not the Q1 results, but the outlook, the Q2, the Q3, the Q4 outlook for these retail
Very
companies.
good question, because that is what some of the bears are focusing on. They're looking at credit card spending. They're looking at all these kind of things to figure out, the Fed has raised rates 9, 10 times, and it hasn't really hit the economy the way everyone's thought it would. They thought it would happen fast, but maybe the consumer and our balance sheets were that much stronger because we've learned from our past mistakes. But now that it's 10 months into this rate rising cycle, that perhaps some savings is being washed out, and perhaps some of the layoffs for a year, we've been hearing about layoffs, and that's why some companies have been going up because of the efficiency of layoffs. So people want to see how healthy is the consumer and how much are they slowing down. Are they slowing down a little for a soft landing? Are they slowing around a lot, where all of a sudden it's going to create a hard landing for the market to break down? So then potentially we do get those rate cuts. So I do think that next week's retail companies are going to be a little bit, are going to be very important, something to focus on. And what you're going to have to do is see where these stocks are in their charts to figure out, is it priced in? Is something trading at the bottom of the range where there's no expectations that they're going to be good, or is something had a big run that they're like, wow, this is going to be great, and then all of a sudden it's less, and then that's how you play it. But overall, the theme is going to be, how much are we slowing, and are we getting closer to a recession? And if we are, is the multiple of the S&P way too high, which is what all the bears are growling about.
Yeah. All right, let's go ahead and get into our audience questions here. Our first question comes from Lauren, and she said, could the market be following hedged calls against short positions in the SPY, or are bears getting squeezed and giving up?
It's a little bit of both. I think I saw some kind of a note saying that hedge funds are more short the SPY since they've been with the S&P since 2011. It's May 10th, 2023. So in the last 12 years, people haven't had as big of bets against the market. So sometimes they're right, and sometimes they're not, and they cause fuel for buying. So that's why we have to really be careful with our levels. And in the S&P, like 4160 to 4200, it's a very key resistance. And then on the support side, it's like 4100 or 4060-ish. So if they're right, they make money short. If they're wrong, and all of a sudden the debt ceiling gets resolved, earnings were pretty good, Apple has a nice move, and tech continues to act in there, and no more regional banks go defunct in the next week or two, they might get squeezed. Just like they did last summer, the S&P went to like 4,300, before then making new lows 6 weeks later. So a lot of this is mechanical, and mechanically, they're a lot more short, and sentiment's a lot more bearish and bullish. So that's something to recognize.
Yeah. Nicholas asked, as someone who is trying to get into professional trading, what would you recommend in order to get experience within the field?
Just start small, and don't expect to make a lot of money in the beginning. Kind of pay your dues. Some people who I know that started in, T3 back in the day when we were all in the New York City office, we'd have like a class of 20 new traders, and they would all think within 6 months they should be making six figures. I'm like, what are you talking about? If you graduated from college and you wanted to be a lawyer, you'd have to go to school for 3 more years and spend $250,000 to $400,000. My wife's a neuropsychologist. She had to go to school for 7 years after and get in debt for like $400,000. So you think that you're going to learn how to trade and make six figures in your first 6 months out of college without paying any dues and learning? You're wrong. Just so take it slow. Don't expect a lot. Plan to lose a little, but keep your mental sanity. Like, this is a nice coffee. And over time, you'll get it, and then you'll start to make good money. But don't lose too much too fast, getting over your skis, thinking you know what you're doing early, because you probably don't.
For me, a follow-up on that, what would you say is the benefit of working with T3 to become a professional versus, doing it on your own and not having maybe the team of T3 behind you?
Well, I think our slogan, I don't know if it still is don't trade alone. I think it is. And if you join T3, you have a community of traders that have been doing it for a living. Some 2 years, 5 years, 10 years. I've been doing it for 25. And
Mm-hmm.
I do have your best interests at heart. I'm not going to baby you. You might not have interaction with me 100%, but you could watch my alpha team. You can give my note. You could tweet me. If you really needed me, I'm there. And there are so many other people just like me that will help a young novice trader, um,
Mm-hmm.
start and have their stages. You crawl before you walk before you jog before you run. We've all done all of that. And I've done
Mm-hmm.
2 Ironman. So, and then after you've done your Ironman, you're an experienced trader. I had back surgery, so sometimes an experienced trader can go through a rut too. You got
Mm-hmm.
to know how to get out of that rut. So we've all been there and done it. So you could use our experience to your benefit, at
Mm-hmm.
whatever stage you are in your trading career, because there's a lot of us.
Yeah. When you think back on your early days of your trading careers, how important was it for you to have a mentor, someone to talk to, someone to, just talk trades with, say this, okay, this is what happened today. Help me figure out what went wrong so I don't do this again.
It's very important. That's such a great question. When I started, it was, 98, and we had the NASDAQ 3,500 go to NASDAQ 5,000. Everyone was like whistling Dixie. They were going with cargo shorts and and sandals, and they were reading the New York Post most active section and making 6 figures a day. So
Mm-hmm.
it was normal then. That was another bubble, kind of like our last one with the pandemic. The stock market was awesome. A lot of us made 4 or 5 times. But when it's slow, when it's hard to make money, when you need somebody to talk to, it's great to have a community of people that can relate to you, that have been there and done that. So I think it's
Mm-hmm.
very important to have mentors and have people that care about you. And there are a lot of T3 that could do that for you.
Yeah. Okay. Our next question comes from Ayub. He asked, what's the best risk management methodology when trading options?
Well, if you buy calls, risk is premium paid. If you buy puts, risk is premium paid. If you
Mm-hmm.
do a call spread, you're risking less to make less. Same thing with a put spread. So those are all ways to trade binary events where you're defining your risk. If you sell naked calls or naked puts, you better be good at it, because your
Mm-hmm.
risk is unlimited, and you better be very extreme. I do that every now and then. I've gotten caught a few times, and I'm pretty good at this. But overall, options are a good way to trade. Um, you know, I trade equities probably 80% of the time, but I've learned how to use options to create cash flow and add hopefully P&L to my yearly gains. I think there's a big formula between equities, options, futures, crypto. You got to figure out how to use your technicals on each of them. And just know that options, historically, most percentage of options go worthless. So there's not a lot of people that are right. So
Mm-hmm.
know that at least with equities, you have a little bit more time to let it work out.
Yeah. Lauren asked about FRC. She asked why the stock is trading on the OTC, and she wonders if it will ever return to the New York Stock Exchange. What are your thoughts? Is it still a business, or are their branches closing? And then, yeah, JPM owns it. So
To
no
zero.
one knows.
Sorry.
Yeah.
I bought puts on FRC, and we made a lot of money from there.
Mm-hmm.
So not that I ever wish bad on people, employees, banks, but technically, if you looked at a chart of FRC, it was disgusting. And
Mm-hmm.
sorry, so that's such a bad word. It was not technically sound.
Yeah.
So with that being said, after Silicon Valley Bank and Signature Bank, it was the next one to go. And now it's trading, I think, at 46 cents on the bulletin board. It's really not even 46 cents. It's probably zero. So if you're still
Mm-hmm.
there, I'm not an expert there, but I would not be hoping and wishing and praying for your money to return there. And it's never
Yeah.
going back to the stock exchange.
Mm-hmm. You as a trader personally prefer to be long over short, correct?
Yeah.
Okay, so
There
that
are
goes
people that
in.
love to be short because stocks do go down faster than they go up when
Yeah,
volatility hits. But
that leads into
historically, the bull market wins.
the question from Adrian. He asked why. Why does Scott find shorting the market harder than going long?
Maybe because I'm a positive, nice guy and I don't wish for bad news. No, that's not true. I'm not saying people who are short are hoping that travesties happen everywhere and companies miss earnings. Just historically though, the S&P over time, the bull market will win. So you get
Mm-hmm.
these sequences of down moves that are fast and furious. So that might happen, a small percentage of the time each year, or a small percentages of the years over a decade. But historically, finding stocks that are going to trend up, that have great businesses, they're going to make higher highs and higher lows, will make you more money versus thinking short and thinking that this isn't going to end well. Because sometimes it
Mm-hmm.
only doesn't end well think about the financial crisis. The worst financial crisis that I ever went through in 2007, 2008 was over in 24 months.
Yeah.
My wife built
Right.
her blood on the street account because of the financial crisis, because she kept buying the S&P funds every single month to get a good cost average. And then by 2012, we were already at S&P all-time highs.
Mm-hmm.
So as a trader, yes, fast money happens, short sometimes, but sometimes you can get grinded higher like last summer, thinking that we're going to turn lower. And then all of a sudden you lost too much short before the chart told you it's ready to be short. So
Mm-hmm.
granted, you don't want to have bull color lenses on, but you don't want to have bare bronzers on either.
Yeah.
What's a bronzer, by the way? I don't
I'm not
know.
sure. Like a bronzer, like is like makeup, but I don't know about.
Yeah,
Yeah.
there you go.
Okay. Lauren asked, in all your years of experience, if to you the market has seemed very orderly, arranged or manipulated since the COVID drop versus years before that. And I think this is kind of a sentiment among a lot of people who maybe got involved in the market during COVID. Is we had that big drop and then this big rise, and then now, as we've discussed, we're in this range. So to a lot of people, it seems maybe somebody is controlling it. So how do you explain the difference in market environments?
Oh yeah, the Wizard of Oz. The Wizard of Oz controlling the whole thing. He's keeping it in the range. Just get Dorothy and have her click her with her finger her shoes, and then the bears will win or the bulls will win. No, but I get it. I was on Liz Clayman's show actually on Friday at Fox Business. She said the same
Mm-hmm.
thing. It's a 2-year range normal. I said, you know what? Why don't you go look at the monthly chart of the S&P cash? Look at 1998 till 2012. We were in a
Mm-hmm.
range for a decade.
Yeah.
Because why? The remember the 80s? You see some movies from the 80s. You have the roaring 80s. They're all having a great time. Ronald Reagan, inflation's going lower, housing's going up. Then you had the go-go 90s with Clinton and the internet and websites, and you had a huge
Mm-hmm.
move to NASDAQ 5000. And then all of a
Mm-hmm.
sudden the tech bubble burst, and then you needed a decade to clean out all the buyers and the sellers to get some equilibrium. And then in
Mm-hmm.
2012, we got above S&P 1500. We went to S&P 4800 in 2021.
Mm-hmm.
So now we're in a consolidation that's wringing out the excess of the easy money for a decade, for low interest rates, for pandemic checks, and for things that need to just consolidate over time, because historically you only go up 7% a year over 100 years, and we borrowed from that, in the past 5. So
Mm-hmm.
consolidating, just like a stock that goes from 40 to 160, has to trade in a range between 120 and 160 for a while to get rid of the sellers, get some new buyers, create a new range for it to go from 160 to 280. It's
Mm-hmm.
just a moment in time. This is where we're at.
Mm-hmm.
Inflation was too high. The Fed had to raise rates. They had to make it harder to get money, make prices come down. So this way, it could be a healthier environment moving forward, and the stock market has to, consolidate and hang out, and we have to act accordingly.
Yeah, great. I think, a great explanation there. Sean asked, what is the most common characteristic of new traders that leads them to failure? And then vice versa, what characteristic leads them to success?
I think a gambler, somebody who wants action, usually leads to failure,
Mm-hmm.
because they want action now, and they think that big trades and big returns should happen, and it takes time for that. I think those have to readjust. For me, I used to love going to Vegas and have fun and gamble and think I'm going to make some money at the roulette and blackjack tables. And I go to Vegas now, and I am not anywhere near the tables. I'm hanging out at Tao Beach. I want some drinks. I want some sun. I'm going to the sauna and steam room and cold plunge. There's no get rich quick scheme. So those who think they're going to get into finance and trading to get rich quick, they have another thing coming. It's those that have a
Mm-hmm.
process, a plan, and a routine, that do it every day, that like what they do, so they're ready to execute with confidence when things move, and then it adds up. And then every now and then, after adding it up and hitting a few singles and doubles, boom, the opportunity meets preparation. You get a little luck, and then you have a really big trade, and then that's a big month or a big year, and that's what makes your life.
Mm-hmm. That's great. For everyone he's still here with us live, go ahead and get your questions in if you have more. I'll keep talking with Scott here on my own, but I want to make sure we're answering the questions that you guys want to be learning about. We've had some really, really great questions so far. So we've talked, kind of a lot today about this market being range bound. What do you think it would take to get this market out of this range, whether that be, turning higher or turning lower?
I think just more time. more time to
Hmm.
know whether, you know, 9 rate hikes is going to really hikes is going to really, you know, slow things down to a point
Hmm.
where corporate earnings really get hurt, where corporate earnings get worse than the efficiency of layoffs. And then if it does, and we really do go into some kind of recession, then the P of the S&P is way too high and it's going to have to come in.
Yeah.
Or over time, we realize that, hey, before the financial crisis, rates were at 4.5%, and it was normal. Okay, the
Hmm.
GDP was 1-2%, and we grew small, and the stock market did a little bit every year. So if all of a sudden the economy can handle 4.5% rates, and we can stay at a 1 to 2% GDP, and the job market doesn't fall apart, and then over time, all the supply is absorbed from all the selling, which it seems like it is, then we start a new bull market, and
Hmm.
hopefully at that point, inflation is a little bit lower and commodities are a little bit lower, which we've seen some cracks in oil, we've seen
Hmm.
some, you know, decline a little bit in natural gas, a lot of it, and some food prices. So, you know,
Yeah.
so we're only going to know over time. How long does
Hmm.
this cycle last? And none of us know. It's all a guess. And I'd rather let the market tell me than try and be one of those guys who thinks they know what's going to happen. I'd rather let the situation, the cycle, and the market tell me what's going to happen.
You mentioned it being a lot more normal pre 2008 for rates to be a lot higher than they've been at any point, really, in the past decade. We're over a decade, I would say, into kind of easy money for the economy. Ignore the rates of 2020 and 2021 that were, zero and people were getting 2% mortgages, sub 2% mortgages. Ignore those. Even pre that, I bought my first house in 2018. I think my mortgage rate was 3.5%, 4%. That was already really, really low. So ignoring ignoring 2020 and 2021, we had a decade over of these easy rates. And so how much overstimulation do you think that puts in the economy and maybe makes this tightening cycle a little tougher for people to get kind of back into the norm of it's not normal to have rates at 2% forever?
You know what, Greta? People are spoiled. People got spoiled. In
Yeah.
Europe, there were negative rates. They were
Yeah.
paying money to hold their money in the banks.
Hmm.
It was too free for too long. They got spoiled. So kind of like if you give somebody 3 salary increases and you take their salary lower, all of a sudden they were happy a decade ago when it was there, but then it was here, now it's there. Like what the hell's going on here? So the
Hmm.
problem is this perception of what's high and what's low. So then you have to find that equilibrium. So
Hmm.
housing a year ago was through the roof. There were people,
Yeah.
you know, overbidding for houses. 10 different people trying to buy a house in Short Hills that was listed for 2 million. They'd go for 2.6. That shouldn't
Hmm.
happen. You couldn't get a car. It was listed for 70,000. People were spending $20,000 over the list price.
Yeah.
That was all too high. So that had to come down because why? Money was too easy to get. Loans were too
Hmm.
easy. So
Hmm.
the Fed had to rein that in. And now, if you buy $1 million house, it's with a 6% mortgage, it now costs you X amount versus a year and a half ago it was 3%. So that means
Hmm.
less people can have enough money to afford that. So housing prices have to come down so the next
Hmm.
generation can buy them because they couldn't buy them where they were a year ago. So it's all one big equilibrium.
Yeah.
And where is that normal spot? That's what the market's trying to figure out.
Yeah.
For me too, I've seen so much, you know, and I thank goodness I refinanced mine and I have like a 2 5/8 mortgage, but I only have till 2029. So
Yeah.
2029, let's see where the world is at and what the situation is.
Yeah. We sold in last year and bought again because we were in a really good selling spot, but not a great buying spot. But we were positioned to be able to afford the mortgage we have now, and then when things kind of regulate again, we'll refinance into more normal rate. I had a really big chunk of questions coming here, so this is great. We have a bunch to get to. Alexander asked, how do you keep track of all the different stocks and trades during the day to not miss the perfect setup? Do you use a scanner?
First of all, there's no perfect scanner or perfect setup. I
Mm-hmm.
usually have a few setups in my mind that I want to do. That's why, someone asked me like, oh, you get up at 4:30 and you do 40 charts. And then after your 40 charts, you do a morning call. And after your morning call, you do another video with the Alpha team. After your Alpha team, you're on the radio. So by the time 9:25 rolls around, I've seen 40 charts 3 different ways. So out of those 40 charts, I have 5 in my head that I feel are like the ones that I don't want to miss. So those are the ones that I focus on. And the only reason why I'm able to focus on it is because I've seen it so many times. That's why I usually get upset if someone comes in at 9 o'clock. It's like, hey, what am I going to do today, Scott? I'm like, don't talk to me. You could have been up, do your own preparation. So literally, I'm so prepared by giving out the content that helps me prepared for the trade. I'm not that exact because, again, I am the chief strategic officer of T3. So there are sometimes I have to be at Fox Business, sometimes CNBC, sometimes meeting with, the founding partners, sometimes meeting with someone from out of town. I try and trade as many things as I can, but my job is to be your chief strategic officer and your offensive coordinator, giving you 40 different stocks with certain types of actionable approaches. Sometimes people are like, Red Dog, you did a chart on, on this name, LCELH, and why are you in it? It went nuts. I'm like, I missed it. It's okay. I'm glad I put it in a certain package for you to take advantage of it, or this or that. So I'm not like it's like a captain on the field. I'm not going to run every route on the football field, but I'll choose a few to help get you guys some first downs and get on top of my back so it could help. Like today, we had a few good trades, and then there were so many others. Like I say sometimes too, you can't kiss all the babies, right? You don't need to be in so many things to net money for a living. You need to be in a few. So I try and pick and choose the ones that I think are the most compelling. And then I just, if I miss a few, psychologically, I know that it's not just my job to catch everything. It's my job to put something out there so you guys have the opportunity to getting involved if you want to.
And I think that's a great, testament to what you do for the Alpha Team virtual trading floor, and for anyone who subscribes to any of your services through T3, is that, maybe you might not be catching all of these trades, but you're giving them kind of a playbook to look at throughout the day, and where they can be and should be can be monitoring stocks to see if that stock will give them their perfect setup to buy into. Eddie asked if he may ask your projection for support and resistance on the VIX. Would there be a chance for us to go below 15, or do you see it still range bounding around 17 and up to 20?
I'll be honest, I don't focus on the VIX. I think the VIX is broken. I think they're going to reverse it every single 4 or 5 years, and it's going back to zero. Don't base your trades on the VIX. Watch your stocks, watch the SPYs, watch the Qs, watch leading stocks. The VIX, if you do trades based on the VIX, you're going to probably not do as well as you could have if you just let the VIX. Listen, every now and then you want to buy a VIX call spread out every 3 months just in case, some kind of black swan event happens. Other than that, every rally in the VIX is sold. So don't be so focused on the VIX, in my humble opinion.
Okay. Lauren asked if you think we'll break the October low in the back half of this year. She said, I assume it depends if we go into a hard recession, and if the Fed cuts, it could mean the economy is in trouble and needs help, which is not bullish. But do we at least test the October low?
That's a gazillion-dollar question, right?
Yeah.
I would say look at the
But
chart of the
everyone wants to
SPYs.
know.
In order to test the lows, the SPY low is 348, the SPYs. So I'll just say S&P is whatever, 3491. In order to test the lows, what's the first thing that's happened? We did this little lesson last time. Remember, Greta?
You have to drop below
and
the
stay
low
below.
and stay below.
So you got to get below and stay below the 8 and 21 day first, or the range 403.78. 403.78 on the SPYs is the low end of this recent channel. In order to test 348, you got to get below and stay below. Not for a day, not for 24 hours and 48 hours, for 2-3 days, and then you have to break the 50-day and the 200-day. So for me to say we're going to go test the lows, it's just an opinion. And at this point, I have different time frames. So my blood on the street account, which only puts money to work when there's blood on the street, is in a fixed rider earning 3.8% in full cash, because I can't add to that because there's no blood in the street.
No blood
If we go back and we break that and we head down, I'm going to buy 3-4 times and hopefully make 10-12% like I've done 3 times in the past 4 years. That's one account. My other account, which is my 401k, that I'm not timing, that I know at age 50, when I'm 65 or 67, I'm just putting money in every single month.
Right.
So there are different ways to save for the long term. And then, but if you trade actively, you have to know the levels that matter. Because if you remember on, what was it, April 25th, we broke below 410 on the SPYs, and it looked like we were done. And then 2 days later, we were back above it, and then made a weekly high at 417. So until the sellers see some type of commitment below a lower level and it stays there, and they show power, who cares? There's no talk about yeah, that's just a talking point for the media and for these guys who are trying to make a name for themselves. So if something happens, they're not caught saying, oh, we were bullish when the market got crushed.
Yeah. Bruce asked how you determine when to day trade a stock and when to swing trade it.
Well, if it's above the 21 day and it pays me to sit in it for a week or two and it's going higher, I'll swing trade it. If all of a sudden it gets choppy, there's misdirection and it's not making me money, like where all of a sudden it's a strong stock, opens down, you could buy more, goes green, sell some, makes a higher high, sell some, pulls in, buy it back. That's a good swing trade. If all of a sudden it doesn't trade methodically and it's losing me money and below the 821 day, it's gone. And then if there's a day trade too, you can get rid of it, and then all of a sudden it's down for 5 days in a row. Then a bad piece of news happens and it gaps down on the 6th day, and the RSI is crazy oversold. Then there's a trade like we did with IEP last week. Never traded Carl Icahn, whatever enterprises before in my life. The short came out, it dropped from 50. It was down for 2 days. People were trying to get me to look at it. I never looked at it. Then all of a sudden, I'm like, oh, look at this. It's below 30 at 28 or whatever it was. It was 128 or 28. I don't remember. Oh, yeah, 28. So I played it from 30 back to 38, and then I haven't touched it since. It was just a day trade. It was a way to take advantage of the over emotion of the situation because we are active traders and we could do that for a living.
Right. Okay, everyone, this is kind of your last call for questions to submit them now as we're starting to close in on the 1 hour mark, and I want to make sure we have time to
Greta, do you know what
get
this is?
to them. It looks like Elon.
Yeah, it is.
Yeah, okay, I was
Elon
gonna say
Musk.
that looks like Elon Musk, but
Trust your instincts. It is Elon. That was from the Joe Rogan. Joe Rogan, is that his name? The interview.
Yeah.
So he's on the wall. Right now, he is below the 821 day. So he's a little fanatical. He's too stretched out. He's not special. But when Tesla's above the 821 day and there's momentum, I can make a lot of money, then he's a genius.
Yeah. Okay. I'll ask a question here as I wait for some more questions to come in as we close in on the end of this here. We have more inflation data coming tomorrow morning. Producer price index comes out 8:30. Oops. 8:30 a.m. just like the CPI today. When you're having these back-to-back releases, I feel like, hold on, let me get my brain going here. Maybe the CPI today, the reaction to the CPI today help you determine how you'll play the PPI tomorrow and any reaction that you see to it?
Yeah, well, tomorrow's PPI will be watered down compared to the CPI unless it's totally different. So usually the first data is the kind of surprising one. The second one usually is similar to the first one, so it's not as important. So I don't think as many people are looking at the PPI the way they were looking at the CPI. They just want to see if it confirms it. If it doesn't confirm it, maybe there'll be a little volatility, but chances are the PPI is not going to be as market moving as the CPI today, unless it's totally different, which it's really hard to do.
Yeah. Okay, I know this is a question you're going to say, everyone wants to know this, and I don't have an answer, but I'll ask you it. Kathy asked you, what's your year-end projection for the SPY?
How about this? I don't think we go below 3,800. I don't think we go above 4,300.
Okay.
So we'll see how it goes. And I have levels in the middle to help me go around it. My job isn't to be putting out projections. I do write a report every year in December about what I think is going to happen, what my base case is. And then when the market confirms certain things, I usually react to it. But from here on out, again, we go below 403 in the SPYs. Maybe we go down to 380. If in order to do that, we have to go below 398. In order to go to 435 on the SPYs, we got to get above 417 and 418, and then you can get to 430. So things have to happen for other things to happen. I'd rather look at that than try and be like this smarty pants. Because listen, I'll tell you, back in 2008, when I was a younger trader, I was on with Mark Haynes, and he's like, I want a call from you. I'm like, okay, gold's going to $1,500 an ounce. It was at 800. Dennis Gartman, the number one guy in the commodity space, Aaron Burnett goes to Dennis, Scott Redler, said that gold's going to $1,500. He disagreed. He's like, he doesn't believe in the American way of life. P.S. 4 months later, gold went to $1,500 an ounce. I was right on the money. I was a young trader. I might have made like 20 grand trading it. There were hedge funds that made hundreds of millions. So it's a matter of making money with your base case versus making a prediction, because this, it's great for me because there are people like on the alpha team. I have some guys that trade $10 billion, some trade $1 billion, some trade 10 million, some have $100,000 and they're in the basement. I don't treat anyone differently. They all pay the same subscription. They could all use the levels in Apple and Microsoft and the SPYs and GLD. But, it's just funny. Back in the day, everyone thought I was like this gazillionaire because I called the financial crisis, I called the rally in gold. And meanwhile, I was making good money. But these guys that were making a gazillion dollars off of my calls, were, I guess, saying, thank you, Red Dog. I'm like, oh, you're welcome. So it's more important, like what you do with your thesis and your calls and how you react and execute versus where you think it's going to go, because thinking about it and executing on it are two different things.
Yeah. Oh, I had a question. I left my mind. Oh, most, professional traders kind of have their basket of stocks that they like. They like to look at on a daily basis. They like to trade because they act well, or whatever your reasoning for it is. What is your basket of core stocks that you're kind of always monitoring, even if you're not in them? And why do you pick those stocks to be your core pieces?
Well, I'm always charting the SPYs and the Qs because that's the backbone of the market. And then after I do the indices, usually the first few I do are the strongest ones that have been the strongest ones for a while. Usually Apple, Microsoft, Meta, Amazon, Google, Netflix. Those are like my bread and butter that I watch every day. And I also, for the last few years, have been always putting AMD and NVIDIA on. NVIDIA has been a leader. AMD's been much better. They used to say AMD was in business, so Intel was a monopoly, but that's crap. Intel's been horrendous for a decade, and AMD's been awesome. And then I just put in things that react and act well into my go-to list. Well, my go-to list is like 40 names, and I would say every 3 months, 6 or 7 of them leave, 6 or 7 of them that act well and had some kind of news and have a new active sequence come in. So my go-to list is probably about 40 names, but I love when Apple's doing great. I love when Tesla is showing momentum. I love it when, Amazon and Google could, it doesn't always happen that way. When energy was great last year, I kind of didn't have, I looked at it, I did a few things, but I wasn't that comfortable. They had to be perfect. So, now this year energy is not special, but, I tend to love when tech is ruling the market. And right now, it's been doing pretty well, so it's been a little bit better, and hopefully it stays that way. And maybe the AD line gets better and the market gets better. But if it doesn't, I'll adjust as well.
Okay, I think that's a good question there to end on. For everyone that is joining us live today, in the chat, I just put a link for my next event that will be with Dan Darrow next week. Next Wednesday, the 17th. Dan, if you've been in the Alpha Team Virtual Trading Floors open house this week, you know who Dan is. He's Scott's, counterpart there in the Alpha Team, and he's an options specialist. So he's a good one to talk to tomorrow for these retail earnings and kind of how you use options to approach events like earnings. So we'll definitely be talking about that. Scott, thank you so much for joining me for today's event. Lots of great questions from the audience, lots of new faces that I haven't seen before. So we thank everyone for joining us, and I thank you, Scott, for joining me as well.
Thanks for having me. This was great. Hopefully everyone learned a little bit and maybe, could make a little bit more money down the road, or at least work on their process in a way that works for them. And we'll see you next time. Looking forward to it.
All right. Thanks, Scott.
You're welcome.